Gary from Texas put $50,000 into 3 AI stocks last summer. He did his homework, watched the YouTube videos, read the articles, checked the charts. He felt good about it. 6 months later, he was down 31%. That's over $15,000 gone. Not because AI isn't real. AI is absolutely real. But here's what nobody told Gary, and what nobody is telling you right now. By the end of this video, you'll understand why roughly 9 out of 10 people who buy individual AI stocks will lose money. Not might lose, will lose. And I'm not giving you opinions, I'm giving you the actual proof. University studies, Wall Street data, and 25 years of history that almost perfectly mirrors what's happening today. There's one number from a study at Arizona State University that will change how you think about stock picking forever. I'll show it to you in a few minutes. Quick note, I'm not a financial advisor or government employee. Everything here is for educational purposes only. For your specific situation, always check with a qualified professional. Let's start with a story you already know, you just don't realize it's happening again. We've seen this movie before. It's 1999. The internet is the future. Everyone knows it. Your neighbor is buying internet stocks. Your coworker just made $20,000 in a month. You feel like you're falling behind. Sound familiar? It should, because right now in 2026, the word internet has been replaced with AI. Everything else is exactly the same. Here's what happened next. The Nasdaq peaked on March 10, 2000. It hit 5,048. Investors were celebrating. The internet was going to change everything. And you know what? They were right. It did change everything. But the crash came anyway. The Nasdaq fell 78%. $5 trillion in wealth disappeared. Over half of all publicly traded .com companies went to zero by 2004. Not down 50%, not down 80%, to zero. Pets.com, Webvan, eToys, Boo.com, all gone. Now here's the part that really matters.
Cisco. Cisco was the best company of the entire internet era. Massive revenue, massive market share. They literally built the backbone of the internet. If there was one safe internet stock, it was Cisco. In March 2000, Cisco became the most valuable company in the world. $80 a share, 220 times earnings. Investors piled in because the business was incredible. Then it fell 86%. And here's the number that should keep every AI investor up at night. Cisco did not get back to its 2000 price until December 2025. 25 years, a quarter of a century just to break even. Let me put real dollars on that. $10,000 in Cisco at the peak sat underwater for 25 years. That same $10,000 in a plain S&P 500 index fund would have grown to over $60,000 in the same period. The business was right. The technology was right. The price was wrong. And in investing, the price is the only thing that determines whether you make money or lose it. Now, here's what's uncomfortable. I'm about to show you the numbers on today's AI and quantum stocks. And when you see them side by side with the .com numbers, you're going to feel something in your gut. That feeling is the point. The numbers that should scare you. Let me be fair first. At the top of the AI food chain, there are real businesses making real money. NVIDIA reported $130 billion in revenue last year. That's not hype. That's not a promise. That's cash. But below that top layer, things get dangerous fast. Palantir. After a huge run in 2025, Palantir reached a price-to-sales ratio of 115. That means investors paid $115 for every single dollar of revenue the company brought in. Its price-to-earnings ratio briefly touched 690. Remember Cisco at the peak of the .com bubble, 220 times earnings. Palantir was 3 times that. Let that sink in for a second. Now, let's talk about quantum computing stocks. This is where things go from expensive to completely disconnected from reality.
Rigetti Computing. In 2025, Rigetti carried a market cap of $6 billion. Annual revenue, $7 million. That's a price-to-sales ratio over 700. In plain English, investors valued Rigetti at $6 billion, even though the company only brought in $7 million. That's like paying $600,000 for a lemonade stand that makes $700 a year. IonQ was the strongest of the group, the first pure quantum company to cross $100 million in annual revenue, but it still lost over $500 million in a single year. And here's what really exposed how fragile this all is. On January 8, 2025, NVIDIA CEO Jensen Huang said useful quantum computers are probably 15 to 30 years away. One comment, one executive, one day. Here's what happened at the closing bell. Rigetti dropped 45%, IonQ dropped 39%, D-Wave dropped 36%, all in one session. That's not investing, that's a house of cards. One comment knocked it over. Now, you might be thinking, okay, but AI is different. The technology is too powerful. The old rules don't apply this time. So let me show you a set of numbers that most investors have never seen, and once you see them, you can't unsee them. The study that changes everything. Professor Hendrik Bessembinder at Arizona State University did something no one had done before. He studied every single U.S. stock listed from 1926 to 2016, 90 years of data, thousands of companies. Here's what he found. Just 4% of all listed stocks created all of the stock market's net wealth. All of it. The other 96% of stocks, combined, merely matched the return of Treasury bills. Treasury bills. That's basically parking your money in the safest, most boring thing that exists. And it gets worse. 4 out of every 7 stocks he studied actually lost money compared to those T-bills. This is the most important number in investing, and almost nobody knows it. It means stock picking isn't just hard, the math is stacked against you. You need to land in the top 4% just to beat a basic savings rate, and you need to dodge the 96% that go nowhere. Think about that in the context of AI stocks. Hundreds of companies are calling themselves AI right now. According to Bessembinder's math, roughly 4% of them will create all the wealth. The rest will match savings accounts or go to zero. Now layer this on top. The S&P SPIVA scorecard tracks professional fund managers against the index. These are full-time experts, Bloomberg terminals, research teams, decades of experience. Over 15 years, more than 90% of them fail to beat the S&P 500. Then there's the behavior gap. The Dalbar study tracks what regular investors actually earn versus what the market delivers. Over 20 years ending in 2024, the average stock investor earned 9.24% per year. The S&P 500 earned 10.35%. Investors lost over a full percentage point every year just from emotional decisions, buying when things feel exciting, selling when things feel scary. So here's where it all connects. 96% of individual stocks fail to beat the market. 90% of professional pickers fail over 15 years. Regular investors lose even more through bad timing. Stack all of that together, and what are the odds that you or I will pick the right AI stock and hold it through the chaos? The math says about 1 in 10, at best. Now, you might be thinking those are old numbers. Maybe today is different. So let me show you what happened to the last group of investors who were absolutely certain they were buying the future. And this wasn't 25 years ago. This was 3 years ago. The body count. Meet Sandra and Rich from North Carolina. Both 57, good jobs, smart people. In early 2021, they put $60,000 into a fund called ARK Innovation, ticker ARKK, run by Cathie Wood, one of the most famous investors in the world at the time. She was on every news channel, every podcast. She called her strategy disruptive innovation. Sandra and Rich believed in the story. By early 2023, their $60,000 was worth about $13,000, 78% gone. And here's the part that stings the most. Cathie Wood sold her NVIDIA shares in early 2023, right before NVIDIA started the biggest AI stock run in history.
She sold the one winner and held the losers. Across all investors, ARKK destroyed roughly $10 billion of wealth while collecting about $300 million in fees. But it wasn't just ARKK. C3.ai, a company with the actual ticker symbol AI, it went public at $42, spiked to $161 on pure AI hype. Today, it trades around $8. $1,000 invested on IPO day is now worth about $185. Supermicrocomputer was the hot AI infrastructure stock. Then their auditor resigned. Then they faced delisting from NASDAQ. Then 3 people tied to the company got indicted for allegedly smuggling NVIDIA servers overseas. 1 stock, 3 scandals. Investors left holding the bag. In 2023 alone, 21 companies that went public through SPACs declared bankruptcy. Over $46 billion in investor money wiped out. Many of them had AI somewhere in their pitch decks. Every single one of these was somebody's sure thing. Before I show you what actually works, drop a comment right now. Have you bought any individual AI or quantum stocks, or are you still deciding what to do? I read every single comment, and I want to know where you stand. Now, here's the question that actually matters. If picking individual AI stocks is this dangerous, is there any way to benefit from the AI revolution without getting crushed? There is, and the answer comes from looking at what the billionaires are actually doing. What smart money actually does. 7 billionaire investors, Warren Buffett, Bill Ackman, Ken Griffin, Chase Coleman, Stanley Druckenmiller, Israel Englander, and Philippe Lafont all wanted exposure to quantum computing. Not one of them bought IonQ. Not one bought Rigetti. Not one bought D-Wave. They all bought Alphabet, the company that owns Google, YouTube, and Google Cloud, a profitable business that throws off billions in cash flow, that also happens to have a quantum division making real breakthroughs with their Willow chip.
That's the model. Own a real business that prints money today and has quantum as a bonus, not a lottery ticket that needs the technology to work out before the company runs out of cash. Charlie Munger once said if someone put a gun to his head and made him buy a tech stock, he'd pick Google. That tells you everything. Now, most of us don't have billion-dollar portfolios, but we can use the exact same principle. It's called the core plus satellite approach. Simple, proven, and anyone can do it. Here's how it works. Keep 80 to 90% of your money in a broad index fund, S&P 500, total U.S. stock market, something like VOO, VTI, or SPY. Boring, diversified, and historically the highest probability path to long-term growth. Then, take 10 to 20% and put it into diversified AI and tech ETFs, not individual stocks, ETFs. AIQ from Global X holds around 84 AI-focused companies for an expense ratio of just 0.68%. Bots, also from Global X, covers robotics and AI across 68 holdings. For semiconductors, SMH or SOXX gives you NVIDIA, TSMC, Broadcom, and ASML for just 0.35%. And for quantum, QTUM from Defiance holds over 70 companies, including Alphabet, Micron, and yes, even Rigetti, but spread across enough names that no single blow-up can hurt you. Here's why this works. Go back to the Bessembinder study. Only 4% of stocks create all the wealth. An ETF guarantees you own that 4% without having to guess which companies they are. You own the entire field, and when the winner emerges, and one always does, you're already holding it. The S&P 500 has returned roughly 10% a year over the last 90 years, not because every stock goes up, most don't, but because the winners win big enough to carry the entire index. That's the math, and it works every time as long as you don't get in your own way by trying to outsmart it. So now you know the proof, you know the history, you know the numbers. Let me give you one line that puts it all together.
The one line that protects your money. The technology always wins. The stock picker almost never does. Own the field, not the lottery ticket. Write that down. Screenshot it. Tell someone you care about. Here's the myth. You have to pick the right AI stock to benefit from the AI revolution. Here's the truth. You just need to own enough of the field that when the winner shows up, and one always does, you're already holding it. That's what an index fund does. That's what an ETF does. That's what the billionaires do. And that's what 90 years of data says works. You're not the kind of person who chases hype. You're the one who looks at the proof first, and the proof is clear. If someone you care about is thinking about putting their savings into individual AI or quantum stocks right now, send them this video. It could save them from a mistake that takes years to recover from. What's your biggest question about investing in AI? Drop it below. I answer as many as I can. If you want to keep building wealth without falling for the hype, subscribe to this channel. I break down what actually works. No noise, no promises, just the numbers. Next one, I'm breaking down the 3 ETFs that quietly crushed the market this year while everyone was chasing AI stocks. You don't want to miss it.